Hello, I'm Celia Anderson, President of the CFA Society Atlanta. Welcome to our online series, the SemiTransparent Active ETF Market. Special thanks to our sponsor, T. Rowe Price. First, just a couple of programming notes. Our annual conferment dinner for our new charter holders will be on November 10th from 5:30 to 8:30 p.m. Our next online series event is entitled Boom, Bust, or Fizzle: How Investors Should Think About SPACs, and that will be on November 17th from 11:30 to 12:30. Finally, our online career series, Take Control of Your Career, is scheduled for December 2nd from 12 to 1. Please register for any of the preceding events at cfaatlanta.org. We are joined today by Tim Coyne and Kevin Signorelli of T. Rowe Price. Tim Coyne is the global head of exchange traded funds at T. Rowe and is the vice president of T. Rowe Price Group and T. Rowe Price Associates. Kevin Signorelli is a senior ETF specialist in the T. Rowe Price Exchange Traded Funds Department. He is also a vice president of T. Rowe Price Group and T. Rowe Price Associates. Please submit your questions via the Q&A feature within the Zoom controls at the bottom of your screen. And with that, I'll turn it over to Kevin to begin. Kevin, it's yours.
Yeah, great. And thank you for the introductions here, Celia. We really appreciate the opportunity to be speaking with you all virtually today, and really excited to chat ETFs for the next 45 minutes or so. So as Celia mentioned, my name is Kevin Signorelli, senior ETF specialist at T. Rowe Price, and I'll be moderating the conversation for the next 35 minutes or so, followed by some Q&A at the end. Tim Coyne, key speaker here today. He's an ETF industry veteran, as Celia noted, and is really a wealth of ETF knowledge and experience. Topic of discussion, again, as Celia highlighted, would be the semi-transparent active ETFs. Look, this is something that is newer to the broader ETF industry and quite frankly to a lot of investors in the marketplace. So we're really excited for the opportunity to provide some insight in our perspective on this kind of newly formed and emerging sub-ETF category or industry even. So everyone is aware on the line, T. Rowe Price entered the ETF industry in the August of 2020. We certainly do view ourselves as a leader in this space, and we're really excited as an organization to now offer some of our active strategies in the ETF wrapper. So let's dive right into the discussion here today. I know we have limited time with you all. Look, as we all know, right, the adoption of the ETF wrapper for many different reasons from both wealth management institutional clients only continues to pick up year over year. If we look at the US ETF market today in the US, right, it's about a $7 trillion market and continues to grow at an impressive rate. The active ETF market in the US has really started to pick up over the past several years as well. It is now about a $250 billion market in the US. And over the past year, there's been this, we'll call it a big splash and/or attention on semi-transparent active ETFs. In particular, from asset managers, T. Rowe included, that are new entrants to the ETF marketplace. So, Tim, let's get you involved here as our key speaker here today. Can you kind of speak to how does T. Rowe Price fit into all of this? Why all the attention around semi-transparent active ETFs over the past year in particular? And kind of you can mix in as well, like, why and how are asset managers thinking about diversifying their offering to their investors? So Tim, I'll pass it to you. Hey, Tim, you're on mute.
Thank you, Kevin.
Yeah, of course.
And thank you all for the opportunity to present here today and have a conversation about active ETFs. So yeah, we're really excited about the ongoing development of the active ETF industry. And maybe just to address the first part of your question, like why is there been a lot of conversation, I guess, in the past 12 months about that? So the big news was in 2020 that the SEC basically provided approval for 5 semi-transparent active models to basically deliver active ETFs to market. That included T. Rowe Price, the NYSE, Fidelity, a company called Blue Tractor and a firm called Presidian. So, with the approval of semi-transparent model, it really represents, I think, a new chapter in the evolution of ETFs. So I've been fortunate to be part of the ETF market for the last 21 years. And dating back to my days at the American Stock Exchange, even back in the early 2000s, there was a level of anticipation at that time that a proprietary active ETF model approval was months away. So this has been kind of a long time coming, I would say, in terms of anticipation to receive final approval. T. Rowe was also the first asset manager to file for our own proprietary active model, and that dates back 8+ years ago. So conversations even within our firm have been ongoing for a decade plus. So the big news here, I don't think it's a knee-jerk reaction for large asset managers to kind of quote jump into the ETF space, but really developing a thoughtful plan and having the right mechanism essentially to deliver active strategies through the ETF wrapper. So I think we've taken a very thoughtful and deliberate approach to building a strong foundation for our ETFs. And just to give you a sense of, and we'll talk a little bit more about this later, but we had, for 2+ years, we had an ETF project at T. Rowe Price that consisted of 15 different work streams and involved over 300 associates. So this is a big lift for us. Certainly, it's a strategic initiative. And I think other asset managers look at it the same way, that ETFs are really just a natural extension to deliver your active strategies. For us and for others, it's been mutual funds, SMAs, other fund structures, trust structures, now ETFs. And we wanted to ensure that we're meeting the needs and expectations of our clients, because clients' needs and expectations are evolving. And in many cases, ETFs really have become the vehicle of choice for many investors. So, you can look at data and it's clear that advisors, more generally speaking, investors of all stripes, that ETFs have become that vehicle of choice and increasingly using ETFs, both in the amount of dollars being invested in ETFs, but also the number of funds that clients are using. So I would say that most, investors and certainly many advisors in particular are using both active and passive strategies in their portfolios. So we wanted to make sure that we were, developing an offering that meets their needs. It's also, I think, interesting when you look at kind of younger demographics. So we have a slide that calls up, looking at different investor segments, and 91% of millennials identify ETFs as their investment vehicle of choice. And if you look at, the next 25 years and the expected transfer of wealth, it becomes pretty clear that ETFs, while we've had significant growth in the market over the past, decade plus in the ETF industry, that there's, I think, a significant amount of growth still to come. And I think active ETFs are going to play a very prominent role. Offering active ETFs also, I think, is consistent with ours and other asset managers increasingly taking a more consultative approach with your clients, making sure that you're working with your clients, understanding their business, and providing them with the opportunity to invest. If they choose a mutual fund and that fits their needs and they're comfortable with that structure, that's fantastic. If they have a greater preference for an ETF and that is the pathway that they decide to take to invest in one of our strategies, that's great too. And active ETFs also deliver the key benefits associated with all ETFs, including being cost effective. And essentially, there's a lower operating cost to an ETF. There's also a convenience level with ETFs and the ability to trade throughout the day. And ETFs historically have been more tax efficient, and that tax efficiency is realized through the create redeem mechanism, which is fairly unique to ETFs. And so I would say all of those things are what makes us very excited to have a new client offering, to be at the forefront, I guess, of a new type of ETF that's being delivered to market. And again, a lot of hard work from our firm perspective, and I know for other firms as well, have gone into building strong foundations to ensure you build the right infrastructure and capabilities to support an ETF business, not just to launch ETFs, but ongoing support and ultimately scale and work with clients.
Yeah, Tim, that's super helpful. And I think, one comment that kind of stands out to me that you make is kind of the vehicle of choice for some investors, right? Not all necessarily. And, the way that I think about it, kind of summarizing some of your comments, especially with active ETFs now being in market, you now have world-class asset managers. You can access their strategy through the ETF wrapper with all those benefits. So it's no longer like, hey, it's a passive versus active discussion. It's like, it's just a vehicle preference, right? And again, getting back to those benefits of, lower costs and, tax efficiency benefits relative to other product structures, simplicity to use, I think are just, something that we position with clients is well received by the industry. So you did hit this on a little bit, Tim, and I was hoping you kind of go a bit further here, more on the technical side. So with semi-transparent active equity ETFs, right? We hear about all these different models or approaches, and at the end of the day, and I know you'll hit on this, all the mechanics around semi-transparent active versus traditional ETF is all the same, but there are some, structural and nuanced differences. So I was hoping you kind of hit on, T. Rowe's model and approach. Like, what does that mean, right, for investors? Like, what is a proxy model? And how do we kind of think about this, as an organization?
Yeah, it's a good question. So maybe start at the kind of macro level. So there are certainly different ways to deliver an active ETF to market. So we just talked a little bit about the semi-transparent approach, and I'll talk a little bit more about the mechanics, I guess, of semi-transparent. There's also fully transparent. A product can be based on an existing investment strategy, or it could be based on a new strategy that's being developed. Also, I think in the past several months, there's been a lot of attention around conversions, right? So you've seen certain firms that have announced that they're converting mutual funds to ETFs. So all of these are, I guess, are considerations in terms of what is the best vehicle structure to deliver that strategy. So I think over time, it's likely that asset managers will pursue pathways based off of the strategies being delivered. And asset manager lineup for ETFs, it's probably not likely either all semi-transparent or fully transparent, but really a mix. And what it comes down to is the strategy and being thoughtful on the best path, and what is best for clients and for the fund operations over time. So for example, to date, our equity ETFs are all using the semi-transparent approach, and for fixed income, we're fully transparent. So I mentioned we developed our own proprietary approach for active equity ETFs. And again, that filing dates back 8+ years, and we finally was approved by the regulators in July 2020. So in terms of funds holding disclosure, our model is a proxy approach. And what does that mean? Our intent is to, 1, protect investment IP, and 2, ensure that we're providing enough information to market makers for them to provide effective pricing in market to effectively quote and provide liquidity in the market on exchange. So we do stop short of delivering a full funds holding file. However, we do provide quite a bit of information. So number 1, just like our mutual funds, we provide quarterly disclosure of fund holdings. It's the same disclosure as mutual funds. Number 2, it's a representative basket, which is highly correlated to the actual funds holdings. So on average, if you look at our equity products, the proxy basket that we produce each day of the fund holdings is 90 to 95% overlap. That proxy is also the primary pricing signal for market makers. Number 3, the proxy basket is also the creation redemption file. So nothing changes there from a creation redemption standpoint. Authorized participants, who are the large broker dealers who are basically authorized to create or redeem ETF shares with us as an issuer, are doing it the exact same way as it's been done in the ETF industry for 28+ years. Number 4, we also produce an INAV, or indicative intraday NAV, which is calculated and disseminated every 15 seconds. And that value is actually based on the actual funds holdings file. And at the end of the day, you can actually view metrics on our website. So you can actually track the performance of the proxy basket relative to the actual fund holdings. So again, while we stop short of that full daily holdings file, we're providing a bunch of information for investors and for market participants to effectively price our products. And this is all coming from a good place. It really is to minimize costs and to maximize our alpha generation to protect the interests of our clients. The real concern and why we stop short of providing the full daily holdings file of our funds is really around the names that portfolio may be trading into or out of. And these names may be in multiple strategies and at scale where it may take us multiple trading sessions to effectively transact. So if that information was published and you could see that we were trading into or trading out of a position, that really opens the door for other market participants to trade ahead and increase trading costs and essentially have a negative impact to the fund and to our shareholders. And from a workflow perspective, I would say the process that we have pursued, there's really no change for a market maker or the authorized participants, as I mentioned. Same process for creation redemption, using the same pricing signals that they would for other ETFs. And I would also mention that, as I mentioned, being thoughtful about what you're delivering, understanding the impact to the portfolio and to your clients is always front and center for us, as I'm sure it is for other asset managers. And, we have 8 products to date in market. So we're kind of new in terms of kind of our ETF offering. I would say we're just taking our first steps on our journey, but we have 5 equity products, and we just recently launched 3 fixed income products, and our 3 fixed income products are fully transparent. So we're comfortable delivering a full daily holdings file, as we don't have the same concerns with the front running potential in the fixed income securities as we do with equities. I mentioned that at the top of the call, there are other model providers essentially out there. So there is also a commercial aspect to various models. Other semi-transparent active model providers are offering their models to other asset managers as a way to deliver their active ETFs in market. And there is a commercial, consideration there. So I'm not sure what the exact charges are, but there is a basis point fee. And that's part of a business model that others are pursuing. So our model was really designed for our strategies and our clients. And while we're open to other asset managers, potentially leveraging our model, that's not something that we've been proactively pursuing. We've had, although we have had dozens of conversations with other asset managers who have approached us to inquire about the potential use of our products. So that's it at a high level. The Proxy is really an indicative basket, stopping short of a full holdings file to help us protect our investment IP and to ultimately protect our investors and put us in the best position to generate alpha, which our clients, have invested and trusted their assets with us to do.
Yeah, that's super helpful. And I think, just from my perspective, having a lot of conversations with, our investors on this, it can be pretty technical, right? When you kind of get into it and all the different kind of, nuances highlighted. But I think you did a really good job highlighting the 2 main differences you need to be aware of as an investor is that 1, we disclose our holdings quarterly, right? Similar to a mutual fund. And then 2, our current redeem baskets are done slightly different, right? But everything else is the same. And I think most importantly, right, you get all the same benefits as, any other ETF ticker that's out there, traditional names like SPY and QQQ and all that. So Tim, thank you for hitting on that. One follow-up question to that, and kind of twofold here. So 1, with these models in general, right, these proxy models in general, T. Rowe's model in general, how has it been received by, we'll call it the industry and specifically, some of our trading partners? And then 2, not so much on the model side, but just kind of our ETFs in general and our story with investors, how have those conversations been going and what has the reception been like?
Yeah, I would add one more point. I think, Kevin, even to your comments, I think with respect to, how these products have been perceived in market. And, I've read a lot like others have about kind of, active, non-transparent, and they've been dubbed ants and stuff like that. We actually push back, have considerable pushback on that. Because as I mentioned, there is disclosure. There's quarterly disclosure of the full holdings file plus all of that other information. And I would say, even looking at, passive ETFs or index-based ETFs, there's different disclosure levels there as well, depending upon, the issuer. So just like, any evolution, I guess, in any market, there are different ways that products are going to be delivered to market. And for me, I just look at this as active ETFs. And I think over time, and I'll talk maybe about this in how clients are receiving it, but the way that I just explained the proxy basket and our approach, we've had those conversations with clients. And many times at the end of, the 2-minute explanation, it's basically like, that's it. And I'm like, that's it. So again, when you look at, what's being delivered, there's nothing really significantly different about the structure. The structure is an ETF structure. The benefits are the same. Again, what we're doing is stopping short to protect investment IP and protect essentially against front running of securities when we're trading in or out of. But I think overall, even leading into this, and I worked at a passive ETF provider for 13 plus years, and then I was on the New York Stock Exchange and the American Stock Exchange, focused on ETFs prior to that. But I think leading into it, that most investors understand the need to protect investment IP. And the big question coming into the development and the launch of SemiTransparent active ETFs was really around the question, is there enough information that's going to be delivered to market participants and market makers to effectively, consistently quote two-sided markets? And what we've seen through data is the answer is yes. Our equity spreads have ranged essentially from 6 to 12 basis points, and on our average are tighter than the industry large cap category, including indexed or fully transparent ETFs. So I would say even in our conversations with regulators, early days for the first 6 months after launch, they did request a lot of information, not just from us, but from the other providers as well, to take a look at market quality and really look at premium discounts, spread quality, how overall trading has been going. And the good news is, after 6-7 months after launch, they were more comfortable with that, the data that they were receiving from the industry, and basically that these products were behaving as designed. And so I would say the good news is that there's far less focus on the model, and there's become more focus on the strategies, and it's become more of a product conversation. So there's still a lot of questions, but I would say in the first 3 to 6 months after we first launched, some of the client conversations that we're having, it was probably 80% dominated by focusing on the mechanics of the structure. Now it's probably 10% of the conversation. It's more of a high level overview. How does it work? How do we think about this? We've seen your spreads. How do these products arrive at such tight spreads, et cetera? So you walk them through, and basically, again, at the end of it, it's like, oh, okay, I get it, I understand. Not that different than any other ETF structure that's been in market for 20 plus years. So the reception from clients has been very good. We've seen steady growth in assets since launch. Currently, there are 11 firms that are using the SemiTransparent active models. There are 40 products in market, and there's 2.2 billion in AUM. So it's been steady, consistent growth.
Yeah, Tim, thank you for sharing that. And again, that's super helpful insight. And I would just note too, I think, we talk about this a lot. Anytime something's new, right, there's just a lot of effort that needs to put on the educational front. And I think your comments around, early on conversations with the investors being heavily focused on the model and the structure has fizzled out. And that's kind of what we envisioned. I think that's kind of what we had hoped for. And now it gets back to competing on, what we're bringing from a strategy level. And even from my perspective, a lot of the more traditional ETF conversations are coming up around tax efficiency and how do I use this in a portfolio? How should I think about this versus, a passive ETF holding? So I think that evolution has been very powerful. and we're starting to see more and more adoption of our ETF lineup. So the last question I have for you, Tim, and then I want to work in some of the Q&A that's starting to come in throughout our conversation. So just like looking out to 2022 and beyond, what do you think's next year for, active ETF market? Are there certain hurdles that you're kind of experiencing now, or you envision for ETF issuers in general? And just kind of your outlook again for what's to come, and how these products be further adopted and utilized by our investor base.
Yeah. And I would say that with any new vehicle structure, asset class, or even any new ETF issuer, it takes time. And I always point back to kind of fixed income as a good example. So the first fixed income ETF products were brought to market back in 2002, but really started to gain traction coming out of the financial crisis in 2009, or 2010. So I would say, you can't measure success in weeks or months. This is going to take years, and it will take a sustained effort to raise awareness in the market, ongoing education, and ultimately adoption. And even when I speak with folks in the media, a lot of times anything kind of ETF related, I think there's some expectation like ETFs were an overnight success, which, certainly they've had tremendous growth over the past, 15 years. However, there was a very modest beginning. And, again, going back to the 90s and the early 2000s, ETFs were just steadily growing. And over time, as there was more awareness, as there were, different things that have evolved in the market that I think have helped accelerate the growth of ETFs, it just takes time. And, we're at about 575 million, call it, in AUM. And, whether skilled or being lucky, our first year AUM projections were pretty modest, but we came in within $20 million of where our expectations were. And so I think we're doing a nice job internally and speaking even externally with clients, with the market. We're patient. We understand this is new. There's a lot of education required here. But what we're starting to see is adoption. And, that's very encouraging. So I think in terms of hurdles, I think developing an ETF business in general and capabilities is a big lift at any firm. And while it's a natural extension, as we discussed, in terms of a vehicle offering, there is a lot of infrastructure build and foundational build that goes with it. And, I would say that ETFs are also unique in many ways versus other structures. It's a listed security. So there's a capital markets element to which for many mutual fund, traditional mutual fund providers, that's something new. That's something new to think about, how to resource that, how to build out that capability. There's a lot of logistics. And if you're an established asset manager, the key is really getting to a point where ETFs are integrated into the firm. And ETFs cut across the firm, including product and investments, marketing, sales, compliance, legal, PR, brand. All those things really need to be plugged in to ETFs and messaging. So you really need to develop an end-to-end apparatus. So, and I know other asset managers are in the process of building out their capabilities around ETFs, but again, it does take time. The other hurdle I would highlight is that right now for SemiTransparent active, there is a limited regulatory approval. So to date, the SEC has approved the use of SemiTransparent structure for securities that trade in U.S. time zone, essentially. So U.S. equities and listed ADRs, and have not approved a structure for SemiTransparent fixed income, or to use the SemiTransparent model for international ETFs. And, so I think right now, again, our hope and expectation is that the SEC, as they get more comfortable with this product structure and more data, that they will eventually approve the use of the SemiTransparent approach for international ETFs, as well as for fixed income ETFs, if a firm chose to go in that direction. And I mentioned just kind of the timeline, and one question that I'm frequently asked is, what does success look like? And my response to that, I'm always hesitant to assign kind of an AUM number to success or a growth projection. But I think to effectively measure success for the semi-transparent or active ETF industry, it's probably a 3 to 5 year horizon, and maybe even a 5 to 7 year horizon. We're operating with a sense of urgency, and I know other asset managers are doing the same. And certainly the sooner you can have that full integration, that helps, I think, bend the curve. But it is going to take some time. And again, success will be measured over years. But I also see active ETFs becoming a huge part of the ETF industry and being very prominent in the portfolios of advisors and ultimately retail, as well as I think institutional use as well. So, I mean, the client question, I think, Kevin, like where do we see the adoption for these products? For us, I think it's with existing clients and mainly for future allocations. We have seen some clients who have converted out from one strategy, one structure to another, but the vast majority is really new flows. Also with new clients, it's an opportunity. While ETFs are great for clients, as we discussed, and additional choice and meeting their needs and preferences, I think it's also really good for asset managers. ETFs provide the opportunity to reach new investors and expands distribution opportunities. And if you look at data, many of the heavy ETF users, they have a significant preference for ETFs. So they may be exclusively or mainly building their portfolios using the ETF structure. So that allows, and historically as a mutual fund provider, an SMA provider, you didn't spend as much time with those types of clients because you didn't have the product offering that they were looking for. So again, I think it's a huge opportunity for asset managers to expand their reach and develop new relationships with clients. I also think that, active ETFs represent the next significant chapter in ETFs. So if I think, where things are going, I think there's two areas that are really poised for growth in the ETF industry. One is active ETFs, and number two, I think, is fixed income ETFs. And we're starting to see fixed income ETFs, AUM, kind of growth start to eclipse that of equities. And that's been a phenomenon in the past couple of years where fixed income is actually now is a direct rival in terms of the AUM that's flowing into, the inflows into ETFs. So I'm a strong believer that ETFs active ETFs are going to play a prominent role in investors' portfolios and continue to grow in relevance and prominence.
Yeah, and on your last 2 points, I mean, yeah, so am I, right? We're all big fans of ETFs here, and I think like one quick plug for T-Rail, and I'll just make it real quick. It's like, look, as we mentioned earlier, we have a dedicated ETF group, right? As an organization, we're highly dedicated to growing our ETF business and our offering to investors. In my role, right, I'm an ETF specialist. We have other ETF specialists. We all have extensive ETF backgrounds, mainly coming from larger ETF issuers. And we're committed to developing our team, our business, and our resources for you all on the ETF side. So Tim, I did, wanted to work in some of the Q&A here that's starting to come in on Zoom. So I think, one good question, especially it's timely, just kind of being, time of the year where cap gains estimates are coming out. I have two questions on ETF tax efficiency. So one is like, how should any investor think about tax efficiency of active ETFs in general, and then kind of working in Rowe Price ETFs? And then two, kind of bigger picture, there's been a lot of chatter in DC about, tax efficiency of ETFs, the in-kind current redeem mechanism, a proposed bill that kind of incorporates maybe eliminating that tax feature. So I'm curious if you kind of hit on both of those questions. I know two different questions, but there is some questions here on Q&A on Zoom that I thought would be helpful for the group to hear you speak about. Yeah,
so maybe I'll start with the just the tax efficiency overall for active ETFs, how to think about that. As I mentioned in my comments earlier, the tax efficiency really comes through the in-kind creation redemption mechanism. And that's what really differentiates ETFs from mutual funds. For active ETFs, I think you have to think of it relative to mutual funds. Over time, I think active ETFs will be more tax efficient than the mutual fund counterparts. However, probably not as tax efficient, perhaps, as a passive index-based ETF. And I say that because, also there's different tools that may be at their disposal that we don't have at our disposal currently to help manage tax efficiency more effectively in the portfolios. But also, like, our primary objective for our strategies is alpha generation, is to outperform. And so, those two things sometimes are in competition a little bit. And we want to make sure that, investors completely understand that, yes, I think relatively speaking, they are going to be more tax efficient than mutual funds. However, relatively speaking, probably not as tax efficient as a passive ETF, right? And then in terms of, I think some of the recent coverage on the tax efficiency of ETFs, and is that something that could potentially be in jeopardy? I don't think so. I guess it's possible. We have been engaged with industry participants, including with ICI and other organizations. So it does seem like early on, like certainly this seems a little bit different. And I would say that the tax efficiency of ETFs and the mechanics seem to come up every few years. And this one seemed a little bit different because it was more tied to a legislative body and potentially to legislation. And but I think it's a low likelihood that we'll see any action on that. And I also think if you look at the premise, of who are who that benefits, it's really retail investors. And I think there was maybe a miscalculation early on in terms of who, this ETFs are open to all types of investors, and it's not necessarily just super wealthy individuals who are using ETFs. It's, ordinary US citizens who are investing in ETFs as their primary investment tool to save for retirement or other goals that they may have in life. So from what we're hearing, it seems like there's a low probability that will gain any significant traction in the near term. But it's always a possibility, I guess.
Yeah, and I think it's good feedback. I think, again, just to kind of quickly summarize, and I would say too, I mean, look, these are complex discussions and there's a lot of different forces in play. We always strongly encourage any investor to reach out to the ETF issuer and hear their perspective, but also how it relates back to their own ETF offering. There's so many different variables to take into consideration. I think it's really important to be, well informed before you make any decision allocating to an ETF in general. The next question we're getting here, and I'll kind of mush a few things together. And Tim, I'll take this one. There's some questions on how to think about performance and trading liquidity and a number of other things. I think this is a pretty good slide that we use a lot with investors in conversation, just to kind of how, different considerations for semi-transparent active ETFs. For example, right, we think about performance, as Tim kind of alluded to, there are some restrictions in terms of what the ETF can hold at this point in time versus, say, a mutual fund, right? Derivatives, non-US ADRs, foreign ordinaries, private placements, like all these types of securities, semi-transparent active ETFs cannot hold, right? So as a result of that, if we look at Rowe Price ETFs that are clone-like strategies of the mutual fund equivalents, it's something to take in consideration. You should look at the performance of the mutual fund versus the ETF. Yes, it's something you can engage, but the reality is there might be some differences in holding at certain periods of time. There might be some slight differences in performance. But I think it's a good one to kind of put on the checklist. Two, and we talked about today, like any ETF issuer, whether they're a new entrant to the marketplace, been a market for a long time, always engage as the kind of resources you have access to in terms of the ETF groups and the ETF issuer as a whole. Do they have dedicated specialists? Do they have dedicated resources? I think that's really important. And even the expertise, right? As Tim mentioned, he spent most of his career in ETFs in many different capacities. I have 10 plus years working in a kind of ETF capital markets business. We think at T. Rowe, we have a really well-rounded team, both internal T. Rowe people as well as people from outside of T. Rowe within the ETF industry, and have some real good perspective on how to think about things. The other one we just hit on is tax efficiency, right? Again, like, get yourself informed. It is important consideration, but it's also not the only consideration, right? There's a lot of different things you'd be thinking about when evaluating any ETF. Then I would say too, just kind of on the trading liquidity side as well, which again is is showing up here in Q&A. I think for any new ETF, right, ETFs kind of go through their natural incubation stage we talk about a lot, right? So it takes time to grow size and scale. Our suite right now is approaching $600 million in AUM overall across our equity and fixed income. Some products we've had in market for a year plus, and some products we've had in market for like a month plus, right? So the secondary market liquidity profiles can be drastically different, and by comparison to some larger, more established ETFs like SPY and the Qs, the liquidity profiles are very different. So I think it's always something to, again, consult with the ETF issuer on, be thoughtful about how you introduce your orders to the marketplace. I know we have a varying degree of investors on the line here today, from advisors to institutional. Trade size, always think about how your trade size sizes up versus secondary market liquidity, how you want to approach that trade, different viable execution strategies you can use at your disposal. And again, consult the ETF issuer. They're a resource there for you and there to help. So I'll pause there. We're about to come up on time, and I want to be respectful of everyone's time here today. But Tim, before we wrap up this last 2 minutes, I'll give you another 30 seconds or so to any closing comments or remarks before I pass it back to Celia.
Yeah, no, thank you, Kevin. So I would just say that, again, we talked about some of the benefits of active ETFs, and I think a lot of kind of scrutiny has been put on active ETFs. And again, we're new, right? And anything that's new to the market, typically there's a spotlight. But in conversations we've had with clients, it's been interesting, I think, recognizing that there are pros and cons. And again, for me, it's about the structure and what's being delivered through the structure, whether that's active or passive. There's pros and cons to each. I think with a passive strategy, one of the limitations is like you're not going to outperform. There's no alpha generation there. And also, the inability to be nimble in certain market environments. And with active ETFs, as we mentioned with the semi-transparent, we talk a lot, or we're questioned a lot on the transparency side of things, right? So as we walk through and people get to understand kind of where we're coming from, I think it clicks and people understand that. So again, for me, I'm very bullish on ETFs, generally speaking. I'm extremely bullish on active ETFs and the growth that we've seen to date, and I think the growth that we will see. And it's a great tool, and I think it fits nicely with, again, certainly our story at T. Rowe Price and how we're looking to develop our business, and just provide a new pathway for investors to reach our investment strategies as our other asset managers. Yeah, no, I totally agree. A lot of good comments in there. And look, I think this is a good discussion today. We hope you found it beneficial. I'll close by saying, if there's any follow-up questions or any topics you want to cover, maybe on the line here today, we're here to help, right? Educate, provide our perspective and feedback. We think we have a lot of good information to share and ideas on a lot of these topics. So please don't hesitate to reach out. And then with that said, I'll pass it back to you, Celia. Celia and Kathy, thank you so much for having us participate today. We always enjoy these opportunities to talk to groups like this. So thank you very much. Thank you.
Thank you, Tim and Kevin. And thanks to everyone who connected with us today. Please look for an event survey to follow shortly. And we do appreciate your filling those in when they arrive in your inbox. And we will also be sending out a replay as well as a slide deck. So thank you all very much.